In the last few hours, silver didn't just climb, it snapped. It punched through a level the market was told was too high, too fast, and it did it while something even more important was happening across the world. The physical market in Asia started paying a brutal premium that the paper market in the West can't ignore forever. That's what happened. Not a theory, not a prediction. A real-world bid for real metal right now. I'm Jon AG, and this is Silver and Golden Signal Lab. And today I'm going to break down why this move happened, why it's different from the last 10 fake-outs, and what it means if you hold silver, watch gold, or you're waiting for mining stocks to finally wake up and go insane. Because this isn't just a rally, this is a stress test. And stressed systems start leaking truth. First, let's kill the biggest lie in the room. The spot price is not always the real price. Spot is a quote, a screen, a paper reference. The real price is what someone pays when they demand delivery and refuses to wait. And today, the delivery price in Asia screamed something the West has tried to bury for years. That premium wasn't small, it wasn't normal. It was the kind of spread that makes professionals stop talking and start calculating. Because in a clean world, a premium like that gets crushed by arbitrage. Traders buy cheap silver in one place, sell it in the expensive place, the gap closes, and everyone pretends the system is balanced. But we don't live in the clean world. We live in a world where paper silver is infinite and physical silver is finite. We live in a world where claims trade like water, while metal moves like molasses. And when the physical side gets tight, that gap doesn't close instantly, it widens, it becomes stubborn. It becomes a warning flare. So if you've been waiting for the moment where the paper price and the physical price stop acting like twins, you might be watching the opening act of a divorce. Now, before the adrenaline takes over, let me give you the one sentence that saves people in markets like this. Big moves create big emotions, and big emotions make smart people do stupid things. Silver is not polite. Silver is a rocket with turbulence. If you're chasing candles, you're volunteering to be shaken out. So here's a question I want you to answer in the comments. Do you think silver pauses at $100, or do you think it blows straight through and shocks everyone? No ego, just your honest read. I want to see where the crowd is leaning. Now let's talk mechanics. Why did silver rip like this? There are 3 engines working at the same time, and when all 3 light up, silver doesn't walk. It sprints. Engine number 1, physical urgency. When buyers stop negotiating and start bidding, the market changes character. You can feel it in the tape. You can see it in how dips get absorbed. It's not buy the dip because it's cute. It's buy the dip because the metal is leaving. Engine number 2, paper overload. On certain days, the paper market trades an amount of silver that looks ridiculous compared to real supply. Hundreds of millions of ounces can churn in contracts like it's a video game. And the public is expected to believe that's normal price discovery. Let's be serious. That's not bars. That's receipts. Receipts are fine when everyone believes the warehouse can deliver. But the moment people suspect the receipts exceed what's deliverable, the entire system becomes fragile. And fragility is the ingredient that turns a normal move into a violent move. Engine number 3, forced buying. This is the part that turns a strong rally into a face ripper. When silver hits key levels fast, short sellers don't get to wait it out. Risk desks don't care about their opinions. They care about the margin call. And a margin call doesn't ask permission. It forces buying into strength. That's why you see candles that don't feel human. That's why you see the market jump like it heard a gunshot. It's obligation buying, not desire. Obligation. Now, let me connect this to the most important clue you should watch from this point forward. Availability. Because price is the headline, but availability is the truth. When the market is healthy, you can always get metal. Selection is wide. Delivery is fast. Premiums are reasonable. Sellers compete. When the market is stressed, you see it in the real world first. Premiums stay elevated, certain products vanish. Delivery times stretch. Sellers start evaluating pricing. That's not marketing, that's strain. And we've already seen signs of that strain. When official sellers pause products or adjust quickly, it's because input costs and demand are moving faster than their ability to keep pricing stable. That's the physical world telling you the chart isn't the full story. Now here's where people get mentally trapped. They see silver near the $90 zone, and their brain screams, "This is insane." And it is insane if you're still anchored to the old range. Not long ago, silver was under $30. That move can make people swing between 2 extremes. Extreme 1, it went up too much, it must crash. Extreme 2, it went up this much, it will go up forever. Both extremes destroy accounts. The winning mindset is process, forces, structure. So instead of obsessing over the number, watch what the number is doing in the context of physical stress. If silver dips and premiums don't drop, the dip is paper. If silver dips and products go out of stock, the dip is a gift. If silver dips and gets vacuumed up instantly, you're watching a market that's tighter than the screen admits. Now let's talk about the chart behavior you're probably noticing. Jagged moves, sudden drops, instant recoveries, that sawtooth pattern that makes people dizzy. That's not randomness. That's a tug of war. Paper sellers can smack the price down with contracts. Physical buyers can't sell metal they don't have, but they can absorb, they can demand, and they can drain. When physical demand is strong enough, every paper slam becomes a buying opportunity for someone who wants delivery. That's how the rebound happens. And the more that happens, the less effective the slams become, because you can't short what's not available. Now we have to zoom out and talk about gold, because gold is the foundation under this building. Silver is the loud move. Gold is the deep move. Gold is the metal that exposes monetary reality. And some serious institutions have run the math on what gold would look like if it had to back even a slice of modern money supply. The implied numbers are huge, not because gold is magical, but because money supply is massive. You don't need gold to hit some cartoon number tomorrow for the point to matter. The point is scale. Paper promises have multiplied. Hard collateral has not. That imbalance doesn't disappear. It either gets corrected slowly through inflation, or it gets corrected violently through repricing. And when gold reprices, silver is sitting right there. Smaller, thinner, more explosive, with a history of wild swings. This is why silver can go from ignored to front page in a week. Now let's address the miners, because some of you are thinking it. If silver is this high, why aren't all the silver miners already on the moon? Here's the truth. Mining stocks are not metal. They are businesses with risks stacked on top of risks. Management decisions matter. Politics matter. Costs matter. Dilution matters. And the market often waits for confirmation before it pays up. But when confirmation hits, miners can move like a trapdoor just opened. Here's the simple leverage. If a miner produces at $25 and sells at $35, the margin is $10. If silver holds around $90 and costs don't explode, that margin becomes massive. Price rises, profit multiplies. That's the leverage people chase. So why do miners lag sometimes? Because the market doesn't trust the price yet. It wants to see it survive. It wants to see earnings reports prove it. And when that happens, capital rotates hard and the ignored stocks become the obsession. But be careful. Not every miner wins. Some are diluted to death. Some are trapped in unstable jurisdictions. Some are run like hobby projects. If you want miners, be selective and stay disciplined. Now, here's the next cliffhanger that decides whether this turns into a controlled climb or a chaotic breakout. Retail awareness. Right now, a lot of demand looks informed and strategic, but retail demand is a different animal. Retail shows up late. Retail shows up loud. Retail buys. Because the number on the screen is scary and the headlines are screaming. And when retail hits a tight market, you don't get a smooth rally. You get gaps. You get rationing. You get limit to per customer. You get out of stock. You get anger. That's the moment people realize silver isn't just a ticker. It's a supply chain, so your job is to watch availability, not just price. If you start hearing consistent reports of empty shelves and long delays, you're watching the market transition from pricing to rationing. And rationing is where the psychology changes completely. Now, we have to talk about behavior, because the biggest enemy in a metal bull market isn't the banks. It isn't the hedge funds. It's you, your own emotions. This market will spike and make you euphoric. Then it will dip and make you doubt your thesis. Then it will spike again to lure you into overconfidence. Then it will slam down to shake you out. That's how it extracts weak hands. So I want you to build rules now while you're calm. What's your time frame? What's your goal? Is this insurance or is this a trade? If you don't have a plan, the market will write one for you and you won't like it. Now let me bring in the funniest serious point of the day, because the community always laughs at this, but it's real. When silver is cheap, your stack looks like your stack. When silver doubles, it becomes our stack. When silver goes parabolic, it becomes my stack. So yes, joking aside, have security, have privacy, have clarity. Your biggest threat to silver might be the sudden attention it attracts inside your own home. Now, I want to ask you another question. Because strategy matters. If the gold to silver ratio compresses hard from here, would you swap some silver into gold? Or are you riding silver all the way? Drop your answer. The ratio is a tool, not a religion. Some people rebalance. Some people ride. I want to see where you stand. Now, there's one topic we have to hit because it affects everything. The copycat problem. There are channels and pages that steal research, steal scripts, steal structure, and try to flood the space with low-effort clones. That doesn't just hurt creators. It confuses the audience, spreads misinformation, and weakens the message. And don't forget, subscribe to support the original work. And if you're part of the movement against copycats, comment Jon AG best so I can see you. That line is more than a slogan, it's a signal. It tells me the real community is here, and it helps this channel keep pushing original work while the noise tries to drown it. Now, let's bring everything together into one clean picture. Because the market is moving fast, and you need clarity, not chaos. We have physical premiums flashing urgent demand. We have paper volume creating distorted price discovery. We have short pressure that can trigger forced buying. We have macro conditions, debt, liquidity, instability that favor hard assets. We have gold pushing the monetary narrative forward. And we have silver, smaller and thinner, reacting like a pressure valve. This combination is not normal. This is not a sleepy commodity market. This is a system under strain. So what should you watch next? Watch the physical premium. If it stays elevated, urgency remains. Watch availability. If shelves thin out, rationing is coming. Watch how silver responds to paper hits. If dips get absorbed faster and faster, physical demand is overpowering. Watch miners relative to metal. If they start catching up aggressively, capital rotation has started. And watch the tone of the mainstream narrative. When the public suddenly starts talking about silver at dinner, the easy phase is already behind you. Now, here's my final thought, and I want you to hold on to it when the candles get crazy. Silver is not just a metal, it's a mirror. It reflects stress in the system. When confidence in paper grows, silver is ignored. When confidence cracks, silver becomes urgent. And right now, urgency is showing up in the only place that matters, the physical market. Now, let me explain the arbitrage trap in the simplest way possible, because this is the mechanism that can drag paper higher even when paper traders try to cap it. If silver is cheap on Western exchanges and expensive in a physical hub like Shanghai, that gap is a profit invitation. Traders buy the cheaper side and sell into the higher bid. Textbook logic says the gap closes fast. But here's the catch. To close it, you need deliverable metal. Not a receipt, not a promise. Metal that can actually move. And when the market is tight, that's where the whole machine starts grinding. If there isn't enough free inventory available, arbitrage doesn't close smoothly. It closes violently. It forces bids higher on the paper side, because the only way to pull metal out of tight hands is price. That's why physical premiums are not a curiosity. They're a lever. They can pull the spot price upward whether the paper market likes it or not. This is also why you'll see the paper price act like it's being yanked higher by something invisible. The invisible force is the physical buyer refusing to accept the paper story. And now we need to talk about the warehouse illusion, because this is where people get misled. Inventory numbers can look big on paper, but the question is always, how much is actually available at the current price? Metal that exists is not the same as metal offered for sale. Metal pledged to someone else is not the same as metal that can be delivered tomorrow. That's why experienced buyers don't just watch spot. They watch premiums, delivery delays, and dealer spreads. They watch whether certain sizes vanish first. When demand starts digging into the bottom of the shelf, the chart stops being a prediction tool and becomes a reaction tool. And remember this, silver is consumed, gold is hoarded. Silver is used, dispersed, and often not economical to recover. That means deficits can build quietly for years, and then the market wakes up all at once when it realizes the buffer is thinner than expected. That's when the move feels like a surprise, even though the setup was building the whole time. Now, on the miner side, I want to give you one filter that saves pain. Look for companies that can survive volatility. A miner with low costs, real production, and balance sheet discipline can ride turbulence. A miner that needs constant financing becomes a dilution machine. In a bull market, dilution hides. In a pullback, it kills. Also remember jurisdiction. In a world of higher metal prices, governments get hungry, taxes rise, permits get delayed, rules change. The safest miners often outperform, not because their ore is better, but because their legal environment is stable. And here's the reality check nobody wants to hear. Silver bull markets are designed to attack your psychology. They tempt you to sell too early, then punish you by running harder. They tempt you to buy too late, then punish you with a shakeout. It's emotional warfare disguised as a commodity chart. So if you want an edge, your edge is control. And if you want another edge, it's understanding how small this market really is. Silver doesn't need the whole world to buy it. It only needs a small slice of capital to rotate in. When that happens, price doesn't adjust gently. It adjusts in jumps. And that brings us back to the danger for short sellers. In a deep market, shorts can escape quietly. In a thin market, shorts get trapped publicly. Every dollar higher tightens the noose, because covering means buying, and buying means pushing price up again. That feedback loop is what turns a normal breakout into a runaway move. So don't underestimate how quickly silver can travel once the market decides it's done negotiating. The chart will look impossible, only because people forgot what a real squeeze looks like in a physical first market. When the crowd notices, the ounces will already be gone, and the only thing left will be higher bids and tighter supply. So I'll leave you with the question that frames the next chapter. Are we heading into a controlled climb or a violent breakout that shocks the market? Because if physical premiums keep screaming and paper claims keep multiplying, the move won't end politely. It will end with the market admitting reality.